It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being with us, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. Here with me, my fellow CFPs at Korhorn Financial Group, Kevin Korhorn and Josh Gregory.
Should you have the same investment strategy across all of the accounts in your portfolio, or is there some reason to have maybe some investment accounts structured differently than other accounts? We're covering that and more on this episode of Wise Money.
I can't believe we haven't hit this topic before. I mean, we've been doing, we're crusty veterans now. We still, every show sounds like it's our first one ever, but crusty veterans. How have we not hit this topic? This is good. We're going to get geeky today. If you have questions for us, reach out to us. You can do so a few different ways. Call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. Submit a question right there on the right. And then all over social media, we get lots of engagement, lots of questions on social media. Find us on YouTube, Facebook, wherever. Just search Wise Money Show. Follow us, like us there, and leave comments there. And all right, so that's a good segue. On YouTube, just maybe a month ago, a few weeks ago. I'm not going to pronounce the name correctly, and it might be a made-up name anyway. But the question came from a fan of the show. With a Roth IRA, what types of options can I hold? And I immediately thought, watch out, sell all your stocks. Just kidding. It was just that, to me, when there are more and more people speculating, that makes me nervous. That's a sign of some capitulation on the upside. But to me, I mean, that's a trading strategy. I look rather.
So hold on. You got to explain though, because you're veering dangerously close to jargon.
Yeah.
So when I ask you the question as a basic bro, hey Mike, what kind of options can I invest in inside of my Roth IRA? Mm-hmm. It could have one of two meanings
or more.
Right, like what tools can I be using? What types of mutual funds, stocks, bonds, that sort of thing?
Right, which that to me said differently. Instead of saying what kind of options in a Roth IRA, I would say what are the investment choices within a Roth IRA?
This fan of the show put in parentheses covered calls and other things. So she was referring to, I believe she was referring to stock options, which is a call is basically you buy the option, so you pay money for the option to buy the stock at a stated price. The price is fluctuating all the time. So you buy the option, not the obligation, the option to buy this stock at a stated price. You actually have to pay money for that option.
Or you sell the right to someone else to buy the stock.
Are we doing a show on options?
Like
this?
Let's
goodness,
not do it.
That would be an option. But I think I think we need to stick to what's at hand. But make the distinction.
Yeah.
When the question, the reason why you rolled your eyes was.
You can see that on the radio?
You can. You can hear the tone of the rolled eye in the microphone. So I think what the question was, can I do options as far as think very technical, advanced trading strategies, a way to add some sort of leverage to either get a better return or protect against a worse return?
Well, so that detail, that's trading strategy. The Wise Money Show is about financial planning. So I looked at that question and thought, what type of investment strategy would I want in my Roth IRA? And how would that differ from maybe my 401k? And that's what I wanted to spend the chunk of time here at the beginning of the show about. Should you have the same investment strategy in all of your accounts, or should you have a different investment strategy? Is it more appropriate to have some investment strategies in this account, but a different investment strategy in this account? And should they be different?
Right. You know, it is a principle that you will always hear us referencing. related to your investments as a component of your financial plan. That diversification is an important tool in your toolbox as you're trying to make wise choices with your investments for some stated goal out there in the future. But diversification can have lots of different meaning. You know, I've met with clients in some small towns before, and there's a belief that they should have diversification amongst their financial professionals. They thought, oh, I should sprinkle some money with this bank and with that broker and this advisor over here, and there I'm diversified. And what they don't realize, as I come along looking at what they've built and help them see, actually you bought basically the same thing with 3 different professionals.
Right.
You're not diversified. You just have more work. You have 3 times as more people to manage in your life, right? So diversification can mean different things to different people. As a principle, you know, we want investments that don't all behave the same way on the same days. We want to spread the risk around in this way so that you can manage the volatility or the fluctuations that you experience in your portfolio. But what we're doing today is kind of taking this to a whole new level and saying, do you diversify now amongst the different strategies or the different philosophies, even amongst different accounts?
To me, this is a tax planning discussion.
For sure.
This is why you can't make a financial decision by just looking at one area of your life, because you look at this and say, well, this is just purely an investment discussion or decision. No, it's not. It's actually rooted in your taxes, because your types of investment accounts have different tax treatment, and your investments have different tax treatment as well, and you want to match up the right investments, right investment strategies, with the right tax shelter or tax treatment of an account. And so really it's a tax decision at its very core. IRAs, Roth IRAs, 401ks, those are types of tax shelters.
Yeah,
HSAs.
keep going. Yeah, so that's I think make a T-chart in your brain right now if you can, or if you got a piece of paper, go ahead and make a T-chart. Because on one side, there are tax-favored investments or tax-sheltered investments. And the other side, there are non-tax-sheltered investments. So on one side, you've got your traditional IRA or your Roth IRA, but a type of an IRA. You've got your 401k. You've got your HSA, health savings account, and you've got your 529 plan. Now, there are more than that, but those are probably the 5 biggies.
Yep.
That typically people would have. And you say, well, it doesn't matter what kind of capital gains or dividend income or whatever it may be I have in those accounts, because I'm not going to get a 1099 at the end of the year saying, hey, you need to pay taxes on these dividends and these capital gains.
All the activity that happens within those accounts is sheltered from taxes. So you can buy, you can sell, you can get a dividend, you can get interest, you can get a capital gain distribution, whatever, and it's all sheltered. Doesn't land on your tax return until you pull money out of that account. Now, on the other side of that T-chart is an individual account. So that's just, you just open up an account, an investment account, go to Robinhood, check it out, whatever. Or a joint account, or a revocable living trust account, family trust account, or an UTMA account, right? So on the other side of that T-chart, you've got a whole bunch of types of accounts, but they're not tax sheltered, right? You want to make sure you've got the right ownership, the right beneficiaries, all that stuff, because lots of times people aren't attentive to that on that side of the T-chart. But anytime you own an investment in one of those accounts that pays a dividend, it's going to land on your tax return. Anytime you sell an investment that has a capital gain, even if you reinvest it right away, it's going to land on your tax return, right? And so there's no tax sheltering that happens over there. So now here's the question. One full segment in, we're now getting to it. Should you have different investment strategies on that first side of the T-chart, your tax sheltered accounts, or even within those? And versus a different strategy for those non-tax shelters. We're going to hit that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. What you're watching right now, this is our weekly 1-hour talk show where we spend a full hour talking about all sorts of various. What are you writing over there, Kevin? What are you doing? Trying to distract me?
150% ownership.
What do you mean?
It's a great. Wait till the next segment. It's coming.
Oh, so good.
It is coming.
Okay.
Because people don't understand that KFG has 150% ownership.
I am so perplexed by what you're saying. If you have a question, leave a question. We will get back to you. And we'll also, if it's a personal question, if you got a need, obviously everything's confidential. We're here to help you. But if it's just a question for the show, we'll hit it on an upcoming program. So leave comments below, turn on notifications, smash that thumbs up, all that fun stuff. And thanks for being here. Okay, let's get into it.
This is good. This is so good.
I can't wait to learn about 150% ownership.
I can't wait to tell you.
All right. Should you have a different investment strategy? Should you hold different investments in your Roth IRA versus your 401k or versus your joint account? Wow, that's good, interesting question. We're hitting that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Why can't I say that? Struggling with KFG studios today.
Too many biscuits and gravy this morning, Mike.
Too many cups of coffee, probably. Every episode of the Wise Money Show is on the YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show, subscribe to it. If you're not a subscriber, turn on notifications, leave comments there, and you get all of the Wise Money content. You get this weekly program and then all other content that we post throughout the week. So go check it out on YouTube. We are talking about that headliner, which is, all right, should you have different investment strategies for different investment accounts? Before we get into it, Kevin's got some opinions.
Well, I want to go there, but it's going to seem like a long, winding, kind of strange road to get there.
I'm used to that.
Me too. It's my favorite. So it's been interesting as a father to talk to my children about financial matters and encourage them to learn and be curious and understand that component of their life. There are many different components to your life. The financial component is one of them. And so Joshua and Caleb early on, they wanted an Xbox. And so I said, okay, if you guys read Rich Dad, Poor Dad and do a book report to Mike and Josh, then you'll get an Xbox. And they did. And they got an Xbox. And
that was a really cool thing to be a part of, by the way.
It was.
I loved hearing what they took away from that book. So jot that down as an idea, you parents. Get your kids reading books that will change their thinking and then have them teach it to someone.
Yep.
That is very cool.
And put something that they want on the far side of something that they should do. Because once you get accustomed to a sense of accomplishment, it's somewhat addictive. Yep. So anyway, most recently I've been working with Joshua, who's still in Iraq in the U.S. Army, and will be coming home here shortly. But he opened a Robinhood account. It seems like all the cool kids are doing that these days, and you get a free stock. And he bought, I think he put about $2,500 in. And he bought Bitcoin and a few other things, and he made $1,000 in 3 or 4 months. So he was pretty pleased about that. And it's kind of the blind squirrel investment strategy, or the I bellied up to the roulette table and put it on red 7, and that's
it's more gambling than investing.
Much more gambling than investing. But here's what happens. So he sent me a text and said, "Hey, Dad, I sold it. I'm going to do something else." Sweet. Nicely done, Josh. You made $1,000. Now, what I told him was your silent partner who had nothing to do with your decision making is going to show up and is going to want 25% of that. So take that $1,000, but that's not all yours. Like 250 of it is going to, between the federal and state governments, is going to go away. And the way I phrased it in the original text is, just remember you're going to have to pay your silent partner. And he said, "Who's your silent partner?" And I said, "Oh, that's the partner that has never shown up to work a day in their life, but when the payday comes, they're going to be standing there with their hand out saying, 'Give me my share.'" And he's like, "Who's that?" I'm like, "What do you mean, who's that?"
someone that's on government payroll.
I can tell you, it's the government.
Well, right. That's interesting that Josh didn't make that connection because he's serving in Iraq now, right?
Right. And the government doesn't have any money except for the money that is collected.
Yeah.
Right. So it's very interesting. And then I got thinking about that, and I was telling him about the ownership of Korhorn Financial Group. And so there are 4 owners of Korhorn Financial Group. So we've got 100% of the ownership divvied up between Kevin, Josh, and Mike. And then another 50% of the ownership is the federal government and the states of Indiana and Michigan. So Korhorn Financial Group has 150% ownership. And it is amazing to me as we did tax planning, we're looking at what's going on here. And we think about, well, wouldn't it be great to pay everyone on our team more? Wouldn't it be great to be able to afford more people on the team? But we have this partner that shows up at tax time and says, hey, I want my cut. And you say, well, what did you do?
These roads. I'm not going to go there. Kevin, come on. I see what you're saying. And if
so,
I can.
So it's interesting. It's a long way of saying, hey, listen, just remember, and it's because I told Joshua, I said, hey, Josh, maybe what you want to do, if you want to gamble on Bitcoin and some of these other things, do it in your Roth IRA.
Yeah.
Right.
And he said, wait a minute, Dad, I don't want to do it in my Roth IRA because I looked at how, because I've done the exercise of saying, hey, let's look at how many times we get this thing to double and what it's going to be when you turn 65. And it's like, no, I don't want to derail that program. And I'm like, well, maybe that's your answer.
It's funny. We were all kind of hanging on what does he mean by 150% ownership, and now I get it. You're saying, listen, every investment, whether you are an owner of a business, whether you bought some Bitcoin, or maybe you've held Apple stock for a bunch of years, every investment is going to have some sort of tax ramifications. And so where you place those investments, what type of account you hold them in is going to determine how much exposure you have to that tax paying. Mm-hmm. And so it is one of the reasons why we're always pointing to the Roth IRA, because all the growth, all the dividends, all the interest that can happen inside of a Roth IRA, it's growing and accumulating tax-free. Mm-hmm. But that's not true of every account. Some accounts, if you and your spouse opened up a joint mutual fund account and you held it for a long, long time, it's growing. It's maybe kicking off some dividends or some capital gains to you, and you're paying tax along the way. Every single year it's having a tax ramification to you. And then when you sell it someday, hopefully you're selling it at a gain. It's really appreciated in value. You pay tax on it at that time too. And so this idea that not all accounts are treated equally by the tax man, it creates some potential traps. Or the flip side of that, the positive side of that would be it creates some potential opportunities if you are planning well within your financial life.
Enough segue. Let's get into it. Let's start with the Roth. So we already said you can have an active strategy in the Roth. You can, because when you buy and sell stuff, there's no tax consequence. You don't have to worry about it landing on your tax return in the short term. So Joshua, your son, not Josh Gregory here on the show, I want to make that clear, could trade Bitcoin in his Roth, even in short term, and there's no tax consequence unless he pulls the money out. But the magic of the Roth is that compound growth, that growth. So the Roth IRA isn't a place where you'd want to put dormant, lazy assets, in my opinion. Mm-hmm. Even if your overall risk tolerance is lower, either right now or that's your stage of life, you want to have your growth-oriented investments in your Roth. So you're good to have an active strategy, like our dynamic, a momentum type strategy, but one that's oriented towards growth. Would you add anything to that?
No, you're kind of alluding to the fact that conventional wisdom might say that the Roth IRA could be some of the latest dollars that you spend in retirement because you want all that tax-free growth to be happening and compounding over a longer and longer period of time. It becomes pretty magical when you let it happen.
So if you're at a point where you're feeling like, yeah, gosh, I'm taking too much risk, I want to downsize my risk, we would encourage you, look at your entire portfolio as you're looking at how much risk should you take, but make sure if some dollars could stay more growth oriented and others more conservative, you'd want the Roth to stay more growth oriented. But we've got to talk about what does that mean for your IRA, your 401k, and your joint account. That and more coming up on the Wise Money Show with Korhorn Financial Group. Third segment. We're going into the third. Okay, good. All right, so we got to hit it here. I think we can. Okay.
So that was quite a wander, but I mean, it is interesting to think. Okay, do I do that in a non-Roth IRA? Do I speculate? Because if I do, it's short-term capital gains. It's treated as ordinary income.
Well,
and if I don't, and I lose my, I have a client who makes $1.5 million a year, and his basis in his IRA is considerably less. I'm sorry, the value of his IRA is considerably less than the basis. And I'm like, how do you do that? I can tell you how. I can tell you.
In other words, if you're listening and that language doesn't make sense, you invested more than what it's worth today.
Considerably more than the value of it. And how do you do that? The only way that you can do that is that you speculate.
Uh-huh.
And you say, well, what do you speculate on? And it's interesting because that was in he was talking about Warren Buffett and why he only has 10 positions.
Yeah.
And he's like, well, you diversify if you don't know. You concentrate if you know. Right. Famous last words.
Yeah. Who knows?
Of the mighty and the proud who have fallen. Yep. Right.
Yep.
Because I can tell you this: my client who had considerably less in his IRA than he actually put in knew when he was making those decisions. He knew. And you say, why would a guy that's that successful need a financial advisor? Because he obviously seems to be doing okay. Because he can't invest for himself. And that is what you would expect.
That's unbelievable.
Yeah.
That's ridiculous.
It's all unbelievable, dude.
Dang. Okay. Let's do it. And a younger, more aggressive Mike Bernard started his career at Korhorn Financial Group after his internship, wanting to do covered calls, and it was all taxable.
Went to Chicago and did some special training, and
I was such a geek.
Yep.
I don't say
Option
that just
strategies.
tongue in cheek. That's for real.
How much of that do you still remember?
Oh, I remember
all of it.
Yeah,
absolutely.
And here's what happened.
You could go trade that way. Today.
No. Because there's
Sure.
a lot of.
Yeah, of course you could, dude. You could. It's just what we learned is, we started with the concept options are not optional. And then as we got into it, we're like, nope, their options are not necessary for most folks.
Here's the thing, and I'm gonna give you just a little bit of a taste of this. This is maybe somehow if we can draw this section out somehow, like point it out. But the strategy was do a bunch of research on stocks that you'd want to own, companies you'd want to own. And there are different criteria that I'd base that on. But companies that you're like, I'm okay holding this thing, okay? And then look at the price today and go 5% higher, saying, I'd be willing to own this company and I could own it for a long time. But if you want to buy it from me at 5% more, I'll sell it to you. So you'd sell a call up here, so you make money. You make some income on the call.
You sell someone the right to buy that stock at a price.
Which obligates you to sell it to them at that price.
Correct, but I'm okay selling it to them at that price because I've baked in a little profit and I've made some income. But if the stock doesn't go up to that level, I'm comfortable still holding it. And then the next month, I'll sell another call and another call and another call. And so it's a covered call strategy that actually, if that's all you wanted to focus on, you didn't want a family, you didn't want a career, and you were okay like being paranoid all the time, it's a good idea. Yeah. But I found
and that is how Warren Buffett will get into and out of positions. He'll use options on his way in or his way out as a way to buy his way in or buy his way out and improve his pricing as he goes.
Mm-hmm. So what happened was there was a company that I ended up liking so much that I went naked on it. And what that means when you're doing a covered call strategy is you line up your calls for the number of shares. So all of your position could get sucked away. Well, there was a company that I liked so much that I was, okay, well, this company's awesome. So I've got calls to sell 1,000 shares away.
That you don't own.
But I want to start having more and more exposure. And then the company was a pharmaceutical company that didn't get a patent over the weekend. So if you've ever thought this, well, if the thing starts sinking, I'll just jump. It closed at $10 a share in change on Friday. It opened at $5 on Monday. Like there was no, why didn't you sell it on Saturday? You can't. Like that's not possible.
Right.
And I wouldn't have known. And so Kevin and I, actually all three of us, we were in a meeting and I checked my computer or whatever, because that's what you did. When you own individual stocks like this, all you do is look at this.
That's what you do when you're in meetings with us?
Yes. and I could barely speak.
This is very interesting.
I could barely speak when I saw, wait a second, no, that can't be the right company. That should be around $11 a share, and it was $5. And that was it. So.
And it cured you of your call strategy.
That was the day I went on my first date with Cindy. And I thought, this money that I'm playing with, I'm going to need that because that's the girl I'm going to marry, I'm pretty sure. So of course I remember that.
Took this really romantic too.
Yeah.
That was pretty slick.
All right, that's enough time we have for today.
Can you send this episode to Cindy and make sure she sees this?
All right, let's get into it. So third segment, let's put this all together here. Should you have a different investment strategy in your 401k than your IRA, than your joint account? We've been talking around this topic, but we're going to answer the question right now, give you some ideas. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. With me in the KFG studios, Kevin Korhorn, Josh Gregory. My name is Mike Bernard. Every episode of the Wise Money Show is on podcast wherever you listen. Just go check it out. Search Wise Money Show. And if you do me a favor, rate the show and leave a comment there. That really helps on podcasts, helps us, helps other people find the show as well. So go check that out. All right, so we're talking about the tax treatment of different investment accounts, the tax treatment of different investments, and how you should match them up. So in the Roth IRA, we said the tax benefit, it's a tax-sheltered account, so you can be active in there. Don't be speculative, because the tax benefit is on the growth. So you want to have as many doubles as possible. You want to have a growth type strategy in there so that you get as much tax benefit as possible, aka tax-free growth. That would differ. So that's a dynamic strategy. I was just looking at the results of our dynamic strategy. It's
for 2020?
Unbelievable. Yeah. It is just unbelievable. But it's active. At any time, we could get a sell and a buy. And you want to make sure but it's a growth type strategy. And so that's perfect for a Roth IRA. Mm-hmm. But in a 401k is also tax sheltered, but you can't necessarily have an active strategy in a 401k. Even though it's sheltered, buying and selling, 401ks have rules and some limitations to them that you can't really be very active with them.
Yeah, it goes back to the .com bubble. And, in the 90s, there were a lot of people inside their 401ks that thought that they were stock jockeys only with mutual funds. They were hopping in and out, almost day trading inside their 401ks. And it creates all kinds of administrative and management headaches for these mutual fund companies. And most of them in the early 2000s started coming out with short-term trading fees that if you didn't hold their mutual fund for at least 90 days or some period of time, they were going to slap you with an extra fee and maybe even ban you from their funds potentially. So the 401k, as you say, Mike, is not a place to have an active strategy most of the time. The exception to that might be if your 401k has a brokerage account linked to it, essentially, where you can actually take some of your 401k assets, shift it over into a segment of this plan that is a brokerage account. Brokerage accounts are investment accounts that you can buy and sell almost anything under the sun inside of. And within that segment of your 401k, if it's offered to you, you may be able to use one of these types of strategies. And we've been able to implement that for some of our clients. Some of our own models that we manage internally for our clients, normally you need to have that in an account with us, but inside of a brokerage window, sometimes you can pull this off.
So the 401k it's tax sheltered. So your dividends, your capital gain distributions, the capital gains when you sell, any interest, that's all tax sheltered. But you can't have a very active strategy unless you're doing that brokerage window like Josh mentioned, which is a great idea, a way to get more diversification. So you're limited in your investment choices. So usually you want to pick a good diversified mix that you can rebalance. Kevin, we've talked about it a lot. Set up auto rebalancing. You make it unemotional and you make sure it's being done, and make sure that that overall diversified mix complements your Roth, complements the other investment accounts, but also is consistent with your overall financial plan and the long-term goals that you have, aka retirement. Now, how would that differ from an IRA? The interesting thing with an IRA, and this, gosh, if we were doing this show 5 years ago, how it would be different than today. Because your IRA, the money you put in is pre-tax. Any activity within there is not showing up on your tax return this year. You pull the money out, and it's taxable as ordinary income. Well, what investments deliver ordinary income? Well, bonds. Something that pays interest. Interest, no matter what the form, it's ordinary income. And that tends to be a higher tax rate than capital gains. So remember this time when bonds paid interest? That would be a good place. You could, if you're looking at your entire portfolio and you said, yeah, I need X percentage of my money in bonds, you'd want to load up your IRA potentially with bonds, because your bonds are going to pay ordinary income anyway. The IRA is going to pay ordinary income. So have your bonds in your IRA, have your growth investments, your stocks or whatever, in your Roth and in your joint account, because the joint account or individual account, that would be capital gain, and the Roth is obviously designed for growth. So that's how you would structure it. It's just today, we were just talking about this big hedge fund manager who said, I would never buy bonds at these prices. So interest rates are just terrible. So you almost have to put a disclaimer on that comment I said.
Yeah, I think if you're not actively working with your financial advisor to say, what should my investment strategy be? And a lot of times people think, well, that's what a financial advisor is. A financial advisor is someone who sells investments. And I would encourage you to kind of expand that concept to say, no, a financial advisor really is a financial planner. So we are all certified financial planners on the show, and we've got 15 client-facing certified financial planners as at Korhorn Financial Group. We serve a lot of people, but it's not just selling investments. It's planning in the 6 areas of financial planning to say, because when I think of, we talk about qualified or non-qualified accounts, I think of that as a cookie jar. Because people will say, well, Josh, how does your Roth IRA investment do?
Yeah. What kind of performance can I get on a Roth IRA?
Right. And that is a great question, because as I've told my children many times, my job is to sit across the table from people all day, every day, and explain things to them that don't make any sense. I mean, this stuff doesn't make any sense until you learn and you understand it better. But within the cookie jar, so if the Roth IRA is the cookie jar, I can have chocolate chip cookies or oatmeal cookies or snickerdoodles or
I couldn't.
Wow.
We could have talked about
you
that.
lost
I'm
me.
feeling distracted now.
I know. I don't. But you can. So it's your choice on what types of investments. You could have a self-directed Roth IRA and own an antique car, or you could own a baseball card or a collectible. Or you can pretty much own whatever you want within these cookie jars. Now we have recommendations on what maybe you would and would not want to own and what you might want to consider. But you definitely want to consider the tax ramifications.
Yeah, this concept of being diversified in the types of accounts you've established is a really, really important one that will become more urgent to you when you get out there to retirement. I just feel like the folks who have the most successful or the most confident feelings in retirement are those who have given themselves maximum flexibility on where they can go draw money out of. They can draw money out of a Roth IRA and pay no tax. They can draw money out of a traditional IRA and pay tax at whatever rate they're in. They can draw money out of a joint account and maybe pay even less tax depending on what kind of growth has built up in that account. But the point is, if you have multiple wells that you could go to draw out of for your own survival in retirement, you get to decide the mix or the ratio of where it comes from, and therefore determine what kind of a tax position you're going to be in and year out. That's why tax planning and investment planning have to be married together within your financial plan.
Sometimes a tax can feel like a tax if you're not playing. Oh, that's terrible. There's a dad joke for you. Kevin, did you get that?
Mike, that hurts.
I know,
that
I'm
hurts
sorry.
even me.
I'm sorry. You got to be planful with your investments, and you want the capital gains dollars, capital gains strategies in your individual account, your joint account, but those might be the dollars you draw from first. So you want to be careful about how much risk you take there. So, all right, we've got questions from fans of the show. That and more coming up on the Wise Money Show with Korhorn Financial Group. Third segment. All right, now we're in the fourth. Land the plane. Okay. It's okay to be
listener questions?
Yeah. We can put a wrap on this, but we definitely should get into questions. Okay, so there's a good one here. I have a question about net investment income. Do long-term capital gains fall in this category? That obviously fits. We've hit Shanu's question.
So this idea of tax diversification is so...
Yeah, let's go to Bruce's question. Have a 401k that consists of both Roth and... Yeah, let's hit Bruce's question after we hit.
I think Josh was talking, but I was thinking about the tax diversification and different types of accounts. And I was thinking one thing that we need to say periodically is if you don't have a Roth IRA, go start one. Get one open and get the 5-year clock started.
Yeah. We'll say that right now. Thanks for being with us today. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. You can do so online, wisemoneyshow.com, or wherever you're at on social media. We are there as well. Just search the Wise Money Show, and you can follow us there and leave questions there. Speaking of, that's where we're getting to next. We've got some questions from fans of the show. First, any last comments about wrapping up how you align your investment strategy with your investment accounts?
Nope. There's never been a better time in the history of the world to accumulate wealth, and there's never been a more complicated time in the history of the world to accumulate wealth. So if you are about the business of accumulating wealth and making sure that you're not getting passed by with opportunities, then I would say make sure you're working with a financial planner. Make sure that financial planner is certified. Make sure they're doing actual financial planning, not just selling you investments. And make sure that the other thing I'd say, here's a freebie, make sure you've got a Roth IRA open.
Yeah.
You're going to want to have a Roth IRA open. Just trust me. Get a Roth IRA opened because you're going to want to have it open for 5 years at some point in time.
Okay.
So...
All right. So this is all centered off of a question that came from the YouTube channel about should you do covered calls and other types of strategies in your Roth IRA. Got another question here that was texted in relating to this topic. And the question, I have a question about net investment income. Do long-term capital gains fall in this category?
Okay, so this is referring to a special tax that was created back in the Obama years, and it was an additional 3.8% of certain types of income that gets added on top of all the other taxes that you were already paying. And anytime the government's coming out with a new tax, they have to decide, well, who's this going to apply to? And at that time, if your income, and still to this day, if your income was over $200,000 as an individual or $250,000 as a married couple, then you could be subject to this extra 3.8% tax on certain types of income. And so the question that was texted in is capital gains amongst the list of items that get slapped with this extra tax? And the answer is yes. So even though we would typically say capital gains tax rates are more favorable than most other rates, that's true until you start getting up into higher income ranges, and some of the goodness goes away because we throw this 3.8% on top. It's also on things like interest income, dividend income, those capital gains that we're being asked about. If you had some rental income or you pull money out of certain types of annuities, the taxable portion might get this added. So there's a whole bunch of places here where if you're not keeping a careful eye on your overall income level, it's possible that you find yourself getting hit with this extra 3.8%.
I mean, there again, this ties right into your investment strategy. Sometimes this is inevitable, like Josh talked about. But with careful planning, it can either be minimized or avoided if you have the right tax strategy and you're using your tax shelters and maximizing those all along the way.
But there are some investment strategies, because if you listen to certain firms, they would say the most important thing is tax-sensitive investing. And so you look at that and you say, well, do I want things that are tax-sensitive or I'm grabbing the wrong word.
Or return sensitive, I think.
No. Stop. It's tax efficient.
Oh, tax.
Because there are a lot of people that say my investment portfolio has to be tax efficient, and there are some strategies that are return efficient, because you say, hey, I want to be tax efficient. Therefore, this year my portfolio is up 12%. I say, well, that's great. Would you rather have it be return efficient and be up 24%? And what if you paid taxes on that whole 24 this year? Mm-hmm. What you did is you in essence you changed your basis or what you've got into that. If you didn't pay any taxes on that 12%, you kicked the can down the road. Not necessarily a bad strategy, but it's in a vacuum or in a silo. These decisions can get kind of tricky.
Yeah. We've got a question from fan of the show, Bruce. Here's what he asked. I'm approaching retirement, and I have a 401k, which consists of both a Roth 401k and traditional 401k. So inside the same 401k, got Roth dollars and pre-tax traditional dollars. I'm considering a rollover to an IRA, but don't know the best way to get this done without being taxed again on the Roth portion of the 401k. Can you provide me with some guidance?
Yeah, I guess we would just provide you with some reassurance.
Yeah.
That money that you already paid tax on inside the 401k and it's growing tax-free. The nice thing is that when you leave your employer and you do what most people do, and that is roll over the 401k, you're actually going to get two different rollovers happening essentially. The Roth dollars can go into a Roth IRA. The traditional 401k dollars can go into a traditional IRA. And that's something that your certified financial planner probably does every day. This is how they help people with the transition between their working years and into retirement. When money starts going into motion, that can be a nerve-wracking time, especially with the kind of scale that, the kind of dollars that you've probably built up throughout your entire working career. It's a lot of money, and yes, mistakes get expensive at that point in life, and that's why I would encourage you to talk through what the overall game plan should be with your certified financial planner, and they'll help make sure that goes smoothly. I just have confidence in that.
Yeah, yep. So to take this a little bit more, more detailed, if you have after-tax dollars, you're going to want to be very careful with that. Oftentimes, maybe you did that early on in your career, or maybe you didn't realize you were doing it or something like that, and then you do that call when you retire to roll over your 401k, and the person on the other end of the line will say, what do you want to do with these after-tax dollars? And they'll say, we can just cut you a check for $5,000, and that feels like a bonus.
Right?
That feels like fun, and maybe that's the right thing, but you you also have the ability to move those dollars directly into your Roth, those after-tax dollars. And another nuance here when you're rolling that money over is if you have any employer stock, you might want to do a strategy called net unrealized appreciation. So Josh, you said it the right way. I'd put your mind at ease. This can go directly into the Roth. That's okay. And your CFP does this sort of stuff all the time. And if that's it, yeah, make sure your CFP helps you. But there might be other issues that your CFP needs to be looking at within your 401k that they can help you as you do that rollover.
Well, and that one that you just mentioned, the net unrealized appreciation, for those of you who do have company stock within your 401k, there are a lot of folks that just kind of get into a rush and they just say, well, you're retiring, so what do we do when you retire? We roll over your 401k. Boom, just done. And if they don't slow down long enough to just check and just make sure that they're not skipping past a potential tax strategy here, that in their effort to help make it easy for you, sometimes you can go a little too fast as well. So that's why, just working with any old investment salesperson is not the way to go. It's someone who is a certified financial planner who's helping you with this transition. And the roadmap that you're using is your financial plan. Yeah. It's structuring this rollover in a way that's going to fund this retirement for you and your ideal future. There are tax consequences, there are investment consequences, there are cash flow consequences with all of this. And so it needs to be part of your overall plan.
Karen from Illinois also is a YouTube fan and sent in this email. She says, hey, I watched your YouTube video about the pitfalls of the Roth 401k that was posted back in December. She said, I'm 73 years old and I'm still working. I have $65,000 in my Roth 401k at work. I've had it since 2008. I thought I was good. Financial planners do not really seem versed in this topic. Unfortunately, I have not started a Roth IRA. I could by December 31st, I think, of that year, but I would start that 5-year clock rolling. If I roll the Roth 401k to a new Roth IRA, does the 5-year waiting period apply to the full amount that I rolled over or just the earnings? In other words, if for some reason I had to touch the contributions, the basis, not the earnings of that Roth IRA, would there be tax consequences on those dollars? So, and then I also understand that after I retire, if I leave that Roth 401k there, I'd have to do required minimum distribution, which that is true on a Roth 401k.
Great question, Karen. You've just lost 97% of the listeners.
Yeah, that is complicated.
So the big idea is that you want to have a Roth IRA opened for at least 5 years. To oversimplify, you want to have a Roth IRA open for at least 5 years, and you say, how can I do that? There are 2 ways to get money into a Roth. One is to contribute, so you put some money in. The other is to convert. So you take money from a traditional IRA and you convert it to a Roth IRA. And you might say, well, listen, I make too much money to contribute. Okay, we got you covered. You can convert. And you might say, hey, I don't want to pay any more taxes than I'm currently paying. Not a problem. We'll convert $100 or $1,000, but a small amount, just enough to get that account open and the clock ticking on that account. Mm-hmm. Yep. So that's where when you're listening to this and saying, what in the world is Karen talking about? If this doesn't hit you where you are, it's because you've either already dealt with it or you haven't faced it yet.
That's right. And so if you're listening and you're within 5 years of retirement or 5 years of wanting to start drawing out of your accounts, I would encourage you just get a Roth IRA opened. This calendar year. I remember at the end of 2020, we had some folks that we were helping facilitate a quick opening of a Roth IRA so that we could grab that one calendar year and get their 5-year clock ticking. So if you just do that much, if you tuck that much away in your arsenal of knowledge and you actually implement it, you're creating opportunities for yourself down the road. And now you've got some time to go educate yourself, work with a certified financial planner who will help you actually leverage those opportunities you created for yourself.
And then your your Roth IRA contributions, you can pull your basis out at any time without a tax or a penalty. And basically the crux of Karen's question is my contribution to my Roth 401k, is that basis, does that carry over to the Roth IRA? That's a good question. I think I'd want to check with the exact custodian. I believe it would. I believe it would, but you're going to want to talk to your custodian, your certified financial planner on that. So, all right. That is all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.